and similar thing can happen in future because this is always a non-linear business that one should understand. So in some 2-3 years span of time, the business really can perform very bad, and in some next 2-3 years, it can actually exponentially grow. In this video, we'll be discussing about the Piramal Pharma business model कि उनके business में कौन-कौन से अलग-अलग categories है, इनके बारे में हम डिटेल में डिस्कस करेंगे. Then we'll be also discussing about currently business is going through tough time, तो उसके क्या-क्या अलग-अलग reasons हो सकते हैं and what are the different triggers for the business in future जहाँ से यहाँ पे कुछ recovery या turnaround आ सकते हैं. तो today again Varun is with us. So Varun, let's first start with the different business categories of the Piramal Pharma which recently got demerged, and then later on we'll discuss about what are the different triggers and what are the challenges the business is facing.
Right. So if you look at Piramal Pharma as a business, they majorly have about 4 business verticals. So the first one is their CDMO vertical, which contributes to about 60% of their revenues.
Okay.
The second vertical is their complex hospital generics, which contributes about 30% to their revenues. The third one is their Indian consumer healthcare business, which contributes to about 10% of their revenues. And the last one is the ophthalmology JV that they have with Allergan. So this is a business that is a joint venture, so it does not contribute to the top line, but it contributes about 65 crores to the PBT of the business.
Right. So let's start with the each vertical in depth. Like let's first start with the CDMO revenue and let's understand how this business has progressed over the period of time. What is the component of the generic CDMO and the novel or the innovative based CDMO? And it is really interesting to know the details about this business because like there is a very less actual information which is given by the management. So we have to dig really deeper to really understand how the business is focused on the novel based or the innovative based CDMO and what is the generic based contribution they are getting. So let's first start with the revenue details of the CDMO as a segment.
So the CDMO business is just like any other CDMO business where they manufacture generic as well as novel drugs for their partners. So if we look at the revenues from this business, in 2012 it was about 1300 crores or so, and it's about 4000 odd crores in FY22. So it has been like it has had a 11.3% CAGR for the past 10 years.
Right.
If we look at the split for this revenue, like about 75% of the revenues from this business comes from the regulated markets, which is from North America, Europe and Japan. Right? And if you look at the revenue split by services, 70% of the revenue comes from commercial manufacturing, 26% comes from the development, and 4% comes from discovery. So now if you look at the commercial manufacturing revenue component, that is about 70% of the total CDMO revenues, which is about 3960 crores. So the commercial manufacturing revenues comes out to about 2772 crores.
Right.
Now we know that in FY22, the revenue that they got from the manufacture of innovative molecules, commercial manufacturing of innovative molecules, was about $56 million. So at 31st March 2022 rates, it is somewhere around 425 crores. So they have 19 commercial products and they made about 425 crores from the manufacturing of these 19 products.
Okay.
The good thing about it is that it was $7 million in 2017. So the business has really scaled up from 2017 to 2022. But if you look at it as a component of the entire business, it is still like a very small portion of the pie. So out of 2772 crores, which is coming from commercial manufacturing, 425 crores is coming from the manufacture of innovative molecules.
Right.
The rest of it is all generic.
Right.
So and then you add to that the development and the discovery pipeline, the revenues from the development and the discovery verticals. Then the total revenue that they are getting from the NCE part of their business is about 40% of the CDMO revenue and about 22% of their total revenues that comes from NCE business, from the NCE business and not the generic business.
Right. So here, as you said, like commercial manufacturing is 70%. So generally commercial manufacturing term is used when you manufacture probably only NCE based or CDMO based business. So here the commercial also includes the generic part of the business, which is not very directly provided by the management. So we have to dig down the data like this and then only we'll come to know like what is the dependency of the business on generic side and what is the actual contribution which is coming from the NCE based molecules.
Yes.
Another point here is we have always seen that when the product become commercial, the revenue actually goes exponentially. Like if you check the Suven Pharma case, the similar thing has happened. And probably this is also a similar thing is happening here in this case, when in 2017, the total revenue contribution from the commercial based NC based products was only $7 million, and it has increased to 56, and similar thing can happen in future, because this is always a non-linear business, that one should understand. So in some 2-3 years span of time, the business really can perform very bad, and in some next 2-3 years it can actually exponentially grow. So we also should not check this business year on year.
Yes, yes. Now, if we move on to their development pipeline that they have. So currently they have about 188 molecules in their development pipeline.
Right.
So of their development revenues, about 46% of the total revenues in the development vertical, which is 26% of the total CDMO revenues.
Okay.
Right? 46% of the development revenues comes from phase 3 molecules. So like if you look at like the total number of molecules that they have, and in this chart we can look at it. So they have a total of 188 molecules, and only 34 molecules out of these 188 molecules are in the phase 3.
Okay.
So as a percentage of the total molecules, phase 3 is only about 16%, but it contributes to 46% of the total revenue from the development business. So here we can see the difference, and we can also see that about 45% of the molecules are in phase 1, which only contributes to about 22% of the revenue. So we can actually understand the difference between how much a company can earn from manufacturing phase 1 molecules versus phase 3 molecules.
Right. So the realization keeps on increasing as your product moves from phase 1 to phase 2 to phase 3, and then commercialized product.
Exactly. And right now, if you look at it, they have about 34 molecules in phase 3. And statistically about, there is a 50% chance that, like the molecules in phase 3 actually go on to commercial manufacturing. So there could actually be like a non-linear growth for them, in the future, 3 or 4 years down the line.
And right now, I think about 19 molecules which are in commercial stage.
Yes.
Okay. So like even if we take like 17 molecules has a potential to go into the commercial manufacturing in next X amount of years.
Yes.
So let's discuss a bit in more detail about this business. So what kind of a capabilities this business has developed over the period of time in case of the CDMO as a category?
Yes. So Piramal has been like very proactive with like, acquiring the capabilities to be like a very differentiated player in this space. So they are not, in terms of capabilities, they are not like your ordinary Indian CDMO, which is like your Laurus or your Divi's, where they are only, or Suven, where they are only into like chemical synthesis.
Right.
They have like a wide variety of capabilities. Maybe Syngene can match them in terms of capabilities, but not the others.
Okay.
So they have like high potent APIs. They can make potent sterile injectables. They can do ADCs, which they've been doing for a very long time now. They've been doing it for the past 10 years. They've been involved in. So a lot of companies are, getting into these verticals now, whereas Piramal has been doing it since the past 10 years. They are into hormones. They recently acquired, peptide capabilities. They acquired a company known as Hemo Pharmaceuticals. Vaccine and biologic capabilities, where they acquired a company called Yapan Bio. They only acquired a minority stake in Yapan Bio, but they are going to be leveraging their capabilities to grow their CDMO pipeline. So they truly are a differentiated player, compared to, like the other Indian CDMOs.
And biologic, this is the first acquisition or something they are planning with respect to biologics. More or less, the business was initially focused on the based on the pharma side of the business.
Right. They have one facility in Grangemouth, which is focused on ADCs. But apart from that, yes, this is the...
Right. So after that, let's discuss more about the complex hospital generics as a division and how it has been growing over the period of time and how it is basically a niche business. I think if you'll ask me what is the best category in this business, it would be probably complex hospital generics.
Absolutely.
So let's understand what are the reasons for this.
So like complex hospital generics is a business where they provide, anesthesia products and other complex products to hospitals. It's mostly a portfolio of anesthesia, which is inhalation anesthesia and injectable anesthesia, which are mostly pain management drugs. So the revenues from this business was about 400 crores in 2012, which has grown to over 2000 crores. So it's been a 5x in the past 10 years, right? So it's a 10-year CAGR of over 17%. Similar to their CDMO business, about 75% of the revenues here also come from, the regulated market. So it is North America, Europe, and Japan. And about 58% of their revenues comes from inhalation anesthesia. 17% of their revenues comes from injectable anesthesia. 16% comes from their intrathecal portfolio, and 9% comes from other segments where they have like certain antibiotics and other drugs which are mostly like still sterile drugs only. They have no tablets, capsules, or anything in this. So they are mostly complex drugs which are sterile. There is no tablets or capsules or any of those solid dosages elements in this. So some of their major products in this are like, if you look under anesthesia, inhalation anesthesia, they are the number one player in sevoflurane in US. So they have the largest market share in sevoflurane. Other than that, they have isoflurane and desflurane. Now desflurane is like the latest generation of inhalation anesthesia. They still haven't got approval for desflurane in US, but they have launched it in other markets. So Piramal is the fourth largest inhalation anesthesia player in the whole world. So there is Abbott, there is Baxter, and then there is Piramal. And then there is another Chinese player, but most of their business is concentrated in China. So if you look at, apart from China, Piramal is the third largest player in this space. Then they have an injectable anesthesia portfolio which they acquired from Janssen in 2016. So here they have like highly controlled substances like fentanyl, sufentanil, alfentanil. So these are like, they have branded products in this which are marketed to hospitals. So these are branded products and they are extremely controlled substances, which means that there are only a few manufacturers of these drugs.
Right.
Apart from that, they also have an intrathecal portfolio which they acquired from Mallinckrodt in 2017. So there they have baclofen, which is a drug used for pain management like spinal pain, and they have a brand Mitigo, which is a morphine.
Okay. So this is basically a high entry barrier kind of a business where there is a less amount of competition, and probably according to our understanding is that like this business might have a bit better margins compared to even CDMO business, because CDMO is dominated by the generic side of business, not actually the NC. So actually these drugs are also generic based drugs, but let's understand what are the reasons why there could be a better margins, and let's understand a little bit about their brand power which they have developed over the period of time.
Right. So these businesses are extremely hard to enter for a new player because, there is like a certain amount of medical devices that are required, a certain amount of capex that a company has to do before entering. So if you look at their inhalation anesthesia portfolio, right? So they provide this inhalation anesthesia gas for them. But for that, you need a vaporizer. This vaporizer is installed in the hospital. Only the company whose vaporizer is installed, you can only use their gas in that vaporizer. So it is kind of like a capex for the company where they have to, like spend money to actually put these vaporizers in all the hospitals. But once they have done that capex, it is kind of a repeat business, sort of like, so Ajay Piramal described it as sort of a Gillette type business where they sell you the razor for really cheap, where they keep selling you the blades regularly. So once the capex for, the vaporizer is done, it is like a annuity type business for the company. Apart from that, if you look at their intrathecal portfolio, this is an extremely complex drug where like there has to be like a pump which is surgically implanted into the patient, and inside this pump is where you actually fill the drug. So the drug has to be approved to be used in the pump. So Piramal's products are actually approved to be used in all the major pumps. So here Piramal does not manufacture the pump, but they are approved for use in all the major pumps. So this is like a very niche area where like a lot of companies are not, entering.
Right. Let's understand with some of the products and how actually dangerous these products can be. Even if you have the very small amount of consumption, it can cause a death. So let's understand about what kind of symptoms these products can have.
Right. So if you look at their injectable anesthesia portfolio, so one of the major drug over there is fentanyl. Now fentanyl is probably the most potent drug in the world. So if we look here, how much fentanyl is actually required to kill a person, a lethal dose of fentanyl, it is like a couple of grams of salt. So fentanyl is an opioid which is used for pain management, but it is used in extremely low doses. So fentanyl is a drug that is way more potent than even heroin. So like this is like the amount of heroin that is, the amount of fentanyl that is required to kill a person is much, much, much lower than that. So it is a much more potent drug. So these drugs are extremely complex to manufacture, sell and distribute because not everybody gets the permission to manufacture these drugs, and not everybody gets the permission to sell these drugs. So it is a very controlled substances, and there are a lot of permissions involved, and there are a lot of compliances that you have to go through if you actually want to manufacture these drugs.
Right.
So it is an extremely difficult business for a new entrant to enter into.
So after that, let's understand like what is their kind of a supply chain, how they have made over the period of time, and what kind of backward integration the company has done. Because this company has the plant which are globally located, which is hardly any company we have seen in a pharma kind of a sector where they have the plants in Europe, they have the plants in US, they have the plant in India, and various other locations.
Right. So one of the strengths in this business that they have is that they are completely backward integrated. So for the inhalation anesthesia, where about 55-60% of the revenues come from, they are completely backward integrated, where
Okay.
they make the gas in USA and in India, and then they had a JV with Navin Fluorine for the supply of certain KSMs.
Right.
So it was a JV that they had with Navin Fluorine, and because they wanted to take control of the supply chain, they completely acquired that JV in Dahej. So now they are completely backward integrated, where they make the KSMs and they make the gas, and then they also have their own sales force which markets these products. So they are completely across the whole supply chain. They are completely integrated. So these products are actually sold in over 100 countries, but they only have a dedicated sales force in their key markets, which is North America and Europe. Their own sales force which deals with the GPOs. GPOs are group purchasing organizations. So in every other geography, they sell these products to distributors. So let's talk a little bit about what GPOs are. So GPOs are like a way for like hospitals to leverage the purchasing power if they come in a group, and they, buy larger quantities of a certain drug. Right. So if you look at hospitals, then they have like very similar requirements, that they will all require this anesthesia, they will all require these antibiotics and a lot of these drugs, right? So what they do is they outsource the purchase of this to a different entity who who negotiates with the vendors on behalf of all of these hospitals. Right. And he gets a bigger discount because he's procuring the drugs in a lot higher quantities. The GPOs, they work in a very similar manner to how PBMs work, for generic drugs. We've discussed about PBMs a lot, extensively in our previous videos. Right. Where, why generic players are not able to make a lot of money in the US, because they have to deal with the PBMs. Because there are so few vendors for these products. There's only 3 players where you can actually source these products from. Like it's Baxter, Abbott, and then Piramal. So they don't have as much power over the vendors, because even the industry, the inhalation anesthesia industry, is very concentrated, with these 3 players.
Right. So it is basically kind of supply demand basically gap. In case of generics, there is a huge amount of supply and the PBMs are like only limited to 3. While in this case, like there is while in this case, the supply is very constant, where there are 3 to 4 competitors, including the Chinese player, and the GPOs are only limited probably 2 to 3, and so there is a equal amount of supply and demand. That's why we are assuming that the margin should be bit better compared to completely generic based products which are basically into the US market. So after understanding complex hospitality as a category, let's move ahead into the third segment, which is Indian consumer based healthcare segment.
Yeah, so their Indian consumer healthcare is a fully branded business, and it is an extremely fast growing business. So here we can see that the revenues from this business was about 138 crores in 2012, close to 750 crores in 2022. Right. So that is a 10-year CAGR of 18.3%. So this is their fastest growing business. So under this business, they have a lot of OTC products. So here they are not dealing with prescription drugs. They are mostly dealing with OTC products, and they're not just dealing with drugs. They also have other ancillary products. So they deal with pain management and skincare and vitamins, minerals, women's health, and antacids and those kind of this baby products, and those kind of products where, like they can create a brand. Right.
So if we check actually this business and compare with any branded based pharma company in India, so real differentiator in this company is they don't need the RM who actually goes to doctor. Probably the sales force might be needed, and the amount of the sales force is also quite low compared to any company like let's take an example of Sun Pharma ka Indian division, or say Indoco Remedies or Abbott. So these guys need a lot of RMs who actually goes to doctor, and then they recommend that these kind of drugs might be taken by the patient by the recommendation of the doctor. So
Right.
basically, prescribed drugs. In this case, it is almost OTC based of the portfolio.
Right. And because it is a OTC portfolio, they have to deal with lesser regulation.
Okay.
And they get a better reach because OTC products, you're allowed to, advertise them, so you can, we have seen TV advertisements for a lot of their products. If you see, like some of their major products, Saradon, Lactocalamine, IPIL, we've seen ads for all of them. And like, we know these products, these are like their power brands. Like Littles, where this is like a baby care portfolio where they have a lot of, like products for, like mothers and babies, and they recently started selling diapers also under this vertical. So it is a completely branded business, and the beauty of this business is that there is no manufacturing involved. It is all outsourced. So they are only involved in the marketing of these products. So it is a good ROCE business.
Right. And if you take any branded kind of a player, maybe it is a Asian Paints or a Pidilite or any player who have created a very good brand, they don't focus much on the manufacturing. They always focus on creating that brand and marketing, and then the distribution thing. They don't always focus on the manufacturing part, and that is the real differentiator. We'll discuss about like what is the potential of this business in future, how much it can grow, and right now it is not contributing much into the profitability, but this business have the real potential to give the actually very good amount of profits for their overall division. So
right now, if you look at their revenue split by their channels, so about 76% of the revenue is coming from their general trade, which is like normal medical shops where they stock these products. 15% is coming from e-commerce, but it is growing fast. Okay. 7% is coming from modern trade, which is like your chains and your supermarkets and all of that, and 2% is coming from institution. So in e-commerce, it is a very fast growing segment for them, and they are present across all the e-commerce platforms. They are present on Amazon, Flipkart, Pharmacy, Healthcart, Nykaa. Wherever their products are applicable on whatever e-commerce platform, they have a presence in that. Right. Apart from that, now they have launched their own website called verify.in, where like they sell these products on their own platform. So management has said that this platform actually got a good boost during the pandemic when their sales force was not able to travel. So they were able to sell a lot of products on their platform itself. Right.
Now let's try to understand what has went wrong in Piramal and what are the challenges the company is facing. And then after that, we'll also discuss about what are the potential trigger for this company. So let's start with the first issue, what the company is facing, which is based on like what is the reason for the drop in the margins.
Right. We have seen in Q3 all the pharma companies have faced like margin pressures. Right. And Piramal is not immune to that. In fact, like Piramal has been affected by it worse than a lot of companies. And the reason for that is there is a mix of, again, macroeconomic factors which are not in their control, and also there are some problems which is like very inherent to their business model. Right. To the way they have set up this business. So their margins have been on a constant downward trajectory since 2020, but it had never gotten this low since even 2016. Like we see here, the margins were 15%, whereas for the 9 months 23, it is only about 10%. So like let's get into like some of the details as to like why these margins have actually fallen. So the first reason for it is the deferment of demand. So like if you look at the current macroeconomic scenario, like the funding situation with the rising interest rates has become actually very difficult for a lot of these innovators. The past 2 years, like these innovators had access to abundant financing, and they were pushing all the molecules that they had to the pipeline to see, like which one they could push to commercialization. Right. But now the funding situation has become a little tight. So they are all rationalizing their pipelines, where they are saying that, okay, we are only going to take forward the molecules which have the highest chance of going to commercialization.
So during this tough situation, there might be a possibility that like the high number of molecules might actually fall off the phase 1, 2, whatever is the phase, and that might hit back to the company. That is the possibility, because overall globally situation is not that really good.
Yes, definitely. So, we could see their development pipeline, which we saw of 188 molecules, like shrink a lot maybe over the next 1 or 2 years. One interesting thing that the management has said is that, this quarter they've been, like participating in a lot of RFPs for phase 3 molecules. And phase 3 molecules, like the innovators usually take time to make the decision to outsource, like these products. So a phase 1 decision will generally take less time for the innovator, to take the decision than a phase 3 molecule. So they have been participating in a lot of phase 3 molecules, which is why there has been like a de- low production in at their facilities, where there is, like this rationalizing of the development pipeline, along with, like innovators taking time to even decide who's going to manufacture it. So what ended up happening is that there is an operating deleverage that is playing out at their facilities, and it is hitting Piramal much more than, like the other CDMO players, because they have high cost plants abroad.
Right, right. So let's now first discuss about and compare with the Piramal business model with the other businesses like Suven or Syngene or Laurus or Divi's. How these companies got affected and how the Piramal got affected, because everyone actually got affected in last 2-3 years. But the Piramal case is a bit different because they have the plants which are located globally.
Right. The major part of, like how they were affected was in their generic portfolio.
Right.
Like if you look at Suven was not as badly affected as Laurus or
because
Divi's.
there is a high percentage of the NC based revenue for the Suven.
Correct. Laurus and Divi's, they both had like a lot of issues in their generic side of the business. The innovator side of the business was still, not as bad, did not do as bad. But if you look at Piramal, they have actually not been doing well. But this is because, like they have plants abroad, whereas, Laurus, Divi, Suven, they all have plants in India where the costs are lower, like the cost to set up a plant, and therefore, like the depreciation, which is a fixed cost which hits your PNL, is much higher. Right. These plants are, like old, so there is a lot of maintenance costs. And the other big component, the other major fixed cost that they are facing is a salary cost. So here, if we see, like the salary cost of their UK subsidiary, which is Piramal Healthcare UK, it is 41% of revenue. So if they are paying 41% of their revenues in salaries, so their EBITDA margins are going to be really low. Even in their Canada subsidiary, we can see that, 2021, there was 41% of their revenues was going only to pay salaries. This is much higher than, like any other Indian CDMO player.
And we have to remember that Piramal is majorly into the manufacturing. Still, the salary cost is much, much higher compared to other company, probably like a Syngene, where they are focused more on a CRO-based activities.
Perfect. If you look at this graph, right, like we can see, like, Suven, Divi's, Laurus, they have, anywhere between like 8 to 10% of their revenues is their salary cost. Syngene is one player who has a much higher salary cost, but that is because, like more of their business is towards the research and less of their business is towards manufacturing. Whereas Piramal, most of their business is in manufacturing, and only about 9 to 10% of their business is the discovery business, which is like a major component for Syngene. So for Syngene, the, employees are like a raw material. So it has to be a higher portion of their P&L. But Piramal's employee costs are much higher than even Syngene. So that is a major fixed cost that hits them. The other problem is that, there is a 24% year-on-year increase in their employee expenses. So the management has said that there are two reasons for this. So first is obviously they've hired a bunch of new employees because, some of their capexes have gone online, in Riverview and Grangemouth. So there is a big increase in their employee expenses. The other problem is that there is a negative impact, of the Indian currency depreciation, relative to all the foreign currencies. So this is actually a benefit that other CDMOs get, where, they have dollar revenues and rupee costs. But for Piramal, it is a reverse. So even if the salary is fixed in like a GBP, as like the Indian rupee depreciates, the percentage of, salary expense on the PNL keeps increasing.
So reporting is into the Indian rupees. That's why this is the issue with the company.
Right. And also, like, they have been facing, like attrition at, a lot of these foreign plants. So these are plants where, like they have, ADCs and sterile fill finish and HPAPs. So like you have to, bring in new employees and you have to train them in the protocols and this and that. So it is a huge cost to the company that is hitting the PNL, which has, like significantly hit their margins. Apart from that, the regular macroeconomic factors which have affected, the pharma industry across, which is, their high raw material cost, and there is a decrease in demand for their generic drugs. But the problem here is that they are manufacturing generic drugs in their UK plant, in their US plant, where, the rest of the world is moving in the opposite direction, where they are moving their generic production to India Piramal still is manufacturing generic, at their high cost plants in US and UK.
But Varun, I think we have to understand the capability of the company, because this is definitely a issue right now, but it might be a transient issue. I'm not talking about even a short term or a medium term. Let's take a like 10-year or basically kind of a horizon, because they are already started developing their capabilities in biologics, HP, API, and different technologies which they are getting well versed. We have seen that they had only $7 million of revenue from the commercialized based innovative drugs, and that has shifted to probably 56 in last 4 or 5 years. So we have to correlate the company's capability and the future potential and what they are offering right now, which is probably not so great business on their CDMO side.
Right. So then if we move on to the next issue, this time Piramal actually had to make a provision for, like a bad debt, which was, so one of their customers, they had a issue with funding and they could not, like pay Piramal. So Piramal has actually made a provision in the P&L for bad debt, which has also hit the margin. So the problem here is that, about 29-30% of their revenue is coming from these emerging biopharmas.
Correct.
So if you look at Suven Pharma, about 90% of their revenues comes from big pharma. So the difference here is that when you have a big pharma company, like let's say Pfizer or a Johnson and Johnson, or like Bristol Myers Squibb. So what happens is that these guys have a lot of molecules in the pipeline, and if one of these molecules fail, it is not the end of the company. Whereas a lot of these emerging biopharmas are just startups which have taken some VC funding. Right. And if the molecule fails, it is the end of the company. So there is a lot of churn here, and the component of emerging biopharma is much higher for Piramal than like other Indian CDMOs.
Right. So just to compare, like in case of Newland, also similar issue is there, that most of the revenues comes from the basically new pharma companies or like single molecule based biotech companies. So that issue is always there till the transition of the business happens more towards the global companies and the bigger, basically bigger innovator companies. So these issues, whatever we have discussed, that is related to CDMO business. Let's now understand what is going on into complex hospitality and generic business.
Right. So if you look at their CHG business, there isn't much of a problem here. So right now in Q3, what they said was that the demand actually outpaced their supply, which is actually a good problem to have. So some of their contract manufacturers were having some capacity constraints, and Piramal has worked with them, and they have actually done some debottlenecking and also invested in some new capacities. So management has said from henceforth they are not going to have these kind of issues in like this vertical at least. But other than that, there isn't much issue in this business.
So after that, let's understand the similar what are the issues which are going on into ICH business, which is their Indian consumer based business.
Right. So even if you look at the Indian consumer healthcare business, it is similar to the CHG business where there isn't a major issue. The problem here is that the business is EBITDA neutral, where the management is spending everything that they earn on trade promotion. So in FY22, they spent about 15% of the revenues from this business on, like media and promotion.
Okay. Where basically the company is right now focusing majorly on the creating the brand. And once that brand is set up, then there can be a good amount of operating leverage, which basically can play out, because when they will hit the bigger revenue number, they won't keep on spending the 15% of the revenue as expenses into the marketing or advertising.
Correct. So the management has said that they will keep investing in the business, till the business reaches 1,000 crore top line. So right now it is about 750 crores. Right. And this is actually a good thing for the business where, like we can see the effects. The business has grown, 37% year on year in Q3. And over the 9 months period, it's grown about 19%. So we could actually see, like significant operating leverage playing out in this business, once this business hits a certain scale. Right. So the next issue that the business is facing is the debt issue. So, the debt issue was not looked at as a very significant issue when, like Piramal Pharma was a part of, Piramal Enterprises. Right. And, like people didn't actually have a sense of, how leveraged this business was when it was a combined entity. Now that it is its own separate entity, like people can see that, okay, this business actually has a lot of debt. And currently they have about 4,800 crores of net debt on the balance sheet. This is not gross debt. The gross debt is over 5,000 crores. It's about 4,800 crores of net debt. And the management had given a guidance, up until Q2 that, their net debt to EBITDA won't go about 4 to 4.5 times. And currently, with the significant drop in their EBITDA,
Right.
on a TTM basis, the net debt to EBITDA stands at about 5x. So this is basically a problem for the business, in an increasing interest rate environment.
So to reduce the dependency on the debt and basically to give some comfort to the business, the management has planned a rights issue at about I think 1050 crores. And the much information is I think they are not giving to the public domain. Last con call also we have heard that more or less they have not shared much information. So let's see what actually comes out with their plan for the right issue and how it can help to the company. They have more or less told that like some amount will be going to the debt repayment and some of that will be going for the capex. So let's discuss about the capex. What kind of a capex the company has planned for their future and what is their plan with that.
Right. So in Q4 of FY22, the company said that they are going to be doing about $157 million of capex, which is about 1200 to 1300 crores
Right.
as and this capex is going to be done, across their sites, so their Canada site, the India Pithampur site, the Riverview site, Grangemouth, Morpeth, all the sites, and in Q3, the management said that the Riverview site, which is in US, which is their HP API site, has actually come online. And in Turbe, which is, the hemopharmaceutical sites for peptides, that capex has also gone live in Q3. Apart from that, they have also added an in vitro testing lab in Ahmedabad. They've not elaborated on what they are going to be getting out of this capex in Ahmedabad, but it is still a capacity addition. And in Grangemouth, which is their ADC facility in UK, is expected to come online by the end of this calendar year. So that's what the management has said. So Q3 of FY24 most likely. Apart from that, they have $100 million of capex which is going to be done over the next 1 year.
Right. Let's now talk about the what kind of a guidance the management has given and what kind of visibility the management sees in their business.
Right. So the management has said that they can grow the top line at 50% CAGR over the next 3 to 5 years. So they have not given any segment specific guidance. They have not give that. But they have said that the overall top line will grow by 15% CAGR over the next 3 to 5 years. And they will get to 20 to 25% EBITDA margins in the next 3 to 5 years.
Right. So right now, if we check, like most of the companies got affected, even the international companies also got affected because of the higher raw material challenges or the supply chain issues or the inflationary basically issues. So this Piramal as a group or as an entity in their pharma business, it is mostly a global based business. So let's now understand how other basically CDMO or CRAMS companies got affected. So if we see from the margin guidance, currently the company is at about 10% margins and it is expected by the management that it can go to 20 to 25% margins. Let's understand if is it really possible or not by comparing the other competitors which are located in, which are basically the global competitors. For them, the basically cost of manufacturing might be nearly same or cost of their salary might be nearly same.
Right. So if we look at the other players, like if we take Lonza or Catland, so these are like the top players in the industry.
Right.
So Lonza in 2022 had about a 32% EBITDA margin and Catland had about 23% EBITDA margin. So it is absolutely possible for Piramal to hit these kind of margins if their NCE business ramps up.
Actually, yeah.
So if you look at Lonza and Catland, like most of their revenues come from the NCE business. So for Piramal to actually hit these kind of numbers, they are going to have to see a significant ramp up in their NCE business. So it is definitely possible and it is up to the management how they execute it from here on.
Okay, now we have understood more or less quite in detail about the Piramal Pharma's business model and what actually the things which got affected and what is the reason for the drop in stock price also. Let's now understand about the what kind of optionality which is available.
Right. So one interesting optionality that the business has is the domestic formulation business. So in 2010, so Piramal sold their domestic pharma business to Abbott. Right. And it was like a record deal in the domestic pharma industry. They sold it at about $3.8 billion, which is about a 30x EBITDA valuation. So it is like one of the highest valuations that has ever been given to a domestic pharma company. So, and there was a good reason for that because, Piramal acquired this business in 1988, Nicholas Pharmaceuticals. And from 1998 to 2010, they made it the third largest domestic pharma company in India. And they had the second best selling drug in India, which is Fencidal, which is like a cough syrup,
Right,
codeine based cough
So
syrup.
it is, I think, very old cough syrup and very famous cough syrup. Probably like 30 years back, people used to have a single cough syrup which is dominated by the Piramal, and there used to be a premium which is charged by the company, which I heard from my parents and grandparents.
Right. So this Fencidal brand is still sold by Abbott, and it is one of their major products even today. So Piramal has like a very good experience in how to like scale this business and do well, how to develop the relationships with the doctors, and how to generate prescriptions. So they are very well versed in this business, and if they have to do it again, they will. I'm sure they can do it very well. So the management has said that they are looking to make an acquisition in this space, the domestic pharma space, and if they find a good candidate at a very attractive valuation, they're going to be making an acquisition in this space. So it is an interesting optionality that we might be seeing in Piramal Pharma, where there is a good chance. We cannot take this as a given. We cannot include this into like our forecast, but it is an optionality that the business has, the domestic formulation business which they might enter into.
Right. So now we got more or less all the understanding about the business, and definitely it was a very long video. So if you have watched the video till now, make sure you like this video and hit the bell icon, because these research probably have taken about a month's time, and we are actually doing this research so that you can understand lot of things which are not directly given into the con calls or not directly given into the annual reports. We might have read last 10-year annual reports, or probably like about hundreds of pages of the con call transcript, and then lot of time has spent into connecting the dots. So we are putting lot of efforts so that you can easily understand what challenges the business is already suffering. So if you are really liking this content and it is actually helping you to take the decisions in various investment opportunities, then we only have the small request that you can like this video. That will really help us to push this content to other investors or the analysts or the viewers, so who are actually looking for what is happening or what are the challenges with the Piramal Pharma as a business model. And if you also wanted to know about like how we are doing the research on the micro and small size companies, we are similarly going in depth about these companies. We are meeting the management, we are going on ground and understanding what kind of capabilities which they have built, because the number actually comes later. Before that, the story starts playing out, and that information you will really get only when you will actually go on ground. That is not available in any annual report or the balance sheet, because these companies hardly have any information which they mention in their annual report. So if you are not joined the microcap club, make sure you join the microcap club. It is basically a community for the like-minded investors where you can ask your doubts. There is a discussion forum also, and I have created various reports on these micro-size companies where actually the data is not available. So you can check out the microcap club, for which you will get the link in description. And if this detailed video is helping us to take the decision on the Piramal Pharma's basically business model, make sure you hit the bell icon and like this video. That will really help us. And we'll meet next week with some other detailed understanding of some other business model.